Hello and welcome to Insight AI Brief Setai. Today we're talking about AIE stock. Before we begin, please don't forget to like, share, and subscribe. So today we're diving deep into AI Energy, ticker AIE. And this one, well, it presents a really interesting, almost contradictory picture, doesn't it?
It absolutely does. You've got this apparent financial stability on one side.
Right, like a solid foundation.
Exactly. But then on the other hand, there's this, significant external pressure, almost like a political headwind, that seems to be really impacting their recent results.
Well, it's definitely a story of internal strength versus external challenges. So, looking at the source material for AIE, I guess we have to start with the big news, the thing investors are reacting to right now.
Yeah, the latest earnings. That's really the starting point.
Okay, let's get straight to it then. The headline figure that probably caused a bit of a shock. We're talking Q2 of this year, 2068 BE, or Q2 2025 for most listeners. What did AIE report?
Well, the immediate number isn't pretty. AIE reported a consolidated net loss for that quarter of 41.47 million baht.
Oof, over 41 million baht in the red. That's not just a slight dip. That's a major reversal, particularly when you look back a year.
Yeah.
How did Q2 2024 look?
It's a really sharp contrast. In Q2 of 2024, AIE actually posted a net profit of 31.52 million baht.
Wow. So profit one year, significant loss the next. That's a swing of, what, over 70 million baht?
Exactly. And that kind of turnaround, that magnitude, that's what gets the market's attention, especially for those focused on the short term.
And it wasn't just a single bad quarter, right? The half-year numbers confirm the trend.
That's right. The first half results, H1 2025, show a net loss overall of 30.33 million baht. Compare that to H1 last year, where they had a net profit of 63.15 million baht.
So clearly something in the operating environment has shifted quite dramatically. Probably, like you said, factors outside their immediate control impacting profitability.
Absolutely. But, this is where the story gets interesting, because when you pivot from that recent let's call it financial pain, and look at the underlying structure of the business, it paints a very different picture. Well, if you look past these last couple of quarters and you examine the balance sheet stability using historical data, say from 2024, the company actually looks remarkably solid, almost like a fortress, financially speaking.
Okay, that's the contradiction we mentioned. Short-term pain versus potentially long-term financial security.
Right.
Let's unpack that fortress idea. What specific numbers, what ratios suggest AIE can actually weather these storms?
I think the first one, and maybe the most striking, is the debt-to-equity ratio, the DE ratio, from the end of 2024.
Okay, what was it?
AIE's DE ratio was just 0.23 times, extremely low.
0.23. Wow. Okay, just for context for listeners, finance theory often considers anything under maybe 1.5x as pretty secure, right?
Yeah.
Because it means the company isn't relying heavily on borrowed money. AIE is way, way below that.
Miles below. I mean, this isn't just low debt. It suggests a very, very conservative approach to capital management. It basically gives them a buffer, or at least the financial flexibility, to absorb these kinds of negative quarterly results and fund their strategy without needing to rush out and borrow at high rates.
That makes sense, though it does make you wonder.
What's that?
Well, is it possible to be too conservative? I mean, does a DE ratio that low maybe suggest they haven't leveraged opportunities for growth in the past? That's always the trade-off, isn't it?
That's a really good point, and definitely something for our listeners to consider. Conservatism is great in volatile times, but maybe less so when things are stable.
Okay, so low debt is a big plus. What about their ability to pay their immediate bills? Liquidity ratios?
Yeah, the liquidity ratios really back up that DE story. So the current ratio for 2024 was 3.10x.
3 times cover.
And the quick ratio, which excludes inventory, was 2.13x. And importantly, both of those actually improved compared to the year before, 2023.
And why the improvement?
It seems it was largely driven by an increase in cash and short-term investments, which came from the profits they made back in 2024. So essentially, they have more than enough liquid assets to comfortably cover their short-term obligations.
Right, so they have the reserves. But managing the balance sheet is one thing. How efficient are they day to day? Are they actually running the operation smoothly or just sitting on cash? What about the cash cycle?
Yes. Operationally, they seem quite efficient. Their cash cycle in 2024 was only 29 days.
Just 29 days, that's quick.
It's remarkably quick. Think about it. That's the time from paying for raw materials to getting cash back from customers. Such a fast turnover shows really tight management of working capital, inventory, and that gives them a cost advantage, which is crucial when your main product price is under pressure.
Okay, so we've established this strong financial base, low debt, good liquidity, efficient operations. Now we have to tackle the big issue, the reason for those recent losses, the external risks. What's the #1 headwind for AIE?
It really comes down to the commodity they deal with, crude palm oil or CPO.
Price volatility.
Exactly. The price of CPO is inherently volatile. And while global markets play a role, the Thai domestic CPO market, well, it's often described as sort of a closed market, meaning government policy can, and often does, step in and influence prices, sometimes overriding global trends. This could be to manage local supply, protect consumers, help farmers.
And we saw a very clear example of this government intervention risk affecting AIE directly back in late 2024, didn't we?
Yeah.
Which impacted their sales volume.
We absolutely did. CPO prices were rising because domestic stocks were low, so the government intervened to try and control those price increases for consumers.
How did they do that?
They temporarily reduced the mandatory biodiesel blend ratio across the country.
Yeah.
It went down from B7, which is 7% biodiesel, to B5, only 5%.
Right, and since AIE's main product is biodiesel.
Precisely. That policy change, overnight, directly cut the mandated demand for their key product. It hit their sales volume in 2024 and certainly contributed to the tough environment they're facing now. It's a classic example of a political risk they just can't control.
Okay, that makes perfect sense then why they'd be looking to diversify. If your main market is subject to that kind of volatility and intervention, you need other options. So what's their strategic escape plan? How are they trying to reduce reliance on CPO prices?
Well, their core strategy seems to be focusing on higher margin, value-added products, things that move them away from that high-volume, highly competitive, government-influenced biodiesel sector.
And the main focus there is?
Refined glycerin. That's the big investment.
Refined glycerin. Okay, so that's taking a byproduct of biodiesel and upgrading it significantly, moving away from fuel into things like chemicals, personal care.
Exactly. They've invested in a specific refinery to produce 99.5% pure refined glycerin. Its capacity is about 100,000 kilograms per day.
100,000 kilos a day. And why is that diversification so important strategically?
Because it shifts AIE into totally different industries. Like you said, personal care products, food additives, potentially even pharmaceutical grade stuff. These markets generally have higher margins than bulk biodiesel, and crucially, they're far less exposed to those domestic fuel policy changes.
Right, it's a classic move up the value chain. Take a relatively low-value byproduct, crude glycerin, and turn it into something specialized and more profitable.
Yeah.
But let me play devil's advocate for a second.
Go ahead.
Is 100,000 kilos a day really enough? I mean, is that scale sufficient to truly offset the risk from their entire biodiesel segment, which is presumably much larger, but subject to these political swings?
That is the key question for the long-term outlook, isn't it? The sources suggest it's a significant strategic step. And they're not just doing that, they're also apparently working continuously on internal efficiencies.
Like, oh,
Things like utilizing other byproducts, like palm fatty acid distillate or PFAD. They can feed that back into the biodiesel process. It's about maximizing the value from every part of the raw palm oil, maintaining cost advantages through economies of scale. That's vital when the price of your main output is depressed.
makes sense. Squeeze every bit of efficiency you can. And to fund this big shift, this glycerin plant, they needed money. We should probably touch on the warrants they issue, the AIE W2 warrants.
Yes, absolutely. The company got approval to issue those warrants, AIE W2. They were allocated for free to existing shareholders with an exercise price of $0.25 buyer dollar per share.
And the purpose was funding.
Primarily funding working capital in these kinds of future investments like the glycerin refinery. But of course, investors always need to be aware of the potential dilution that comes with issuing new shares or warrants.
Right. Were there any projections on that dilution based on the filings?
Yes, based on the historical data used at the time, the theoretical price dilution was estimated around 12.63%.
And earnings per share.
The EPS dilution was projected a bit higher at 16.13%. It's that standard trade-off, really.
Yeah.
Potential dilution now in exchange for capital to hopefully fund growth and reduce risks down the line.
Okay. Let's move to our final section then. What are the analysts saying and what do the technicals look like? Starting with the institutional view, what are the big banks and research houses telling investors about AIE's target price right now?
Well, this is actually really important, maybe the second most important piece of non-information, if you like.
Meaning?
Meaning our source material explicitly states it does not provide any recent target prices or consensus buy-sell-hold recommendations from major financial institutions for AIE stock.
So there's basically a coverage gap. No recent analyst reports feeding into the consensus.
That's what it looks like. And that lack of guidance, especially after a big loss and announcing this strategic shift, well, it probably tells you something.
Yeah, it suggests the market, or at least the analysts covering it, might be taking a wait-and-see approach. They likely want to see actual results from that glycerin plant before putting a firm valuation on the stock.
Precisely. It signals quite a bit of uncertainty, or maybe just low coverage right now. It forces you, as an investor, to rely much more heavily on your own analysis of the fundamentals we've just discussed.
Okay, no analyst targets. What about dividends? Is there a policy? Is it reliable, or is that also subject to the ups and downs?
AIE does have a stated dividend policy. They aim to pay out not less than 40% of their net profit each year, after setting aside legal reserves.
Okay, so there's a floor, at least in theory, assuming they return to profit.
Right, but what's really interesting is their recent payout history. In 2024, the dividend payout ratio was, well, it was 143.02%.
143%. Wait, they paid out more in dividends than they earned in net profit that year.
Apparently so, significantly more.
How does that even work? Is that sustainable? Or is it a sign of something else?
It's likely a sign of very strong liquidity at the time. They probably drew on retained earnings from previous, more profitable years, or perhaps had unusually strong cash flow during that specific period despite lower net profit. It definitely shows a willingness from management to reward shareholders.
But you can't keep paying out 143% forever, surely.
No, absolutely not. You have to interpret that very cautiously. It's not sustainable long term. Future dividends are going to depend entirely on getting back to consistent profitability, likely driven by the success of that new glycerin business.
Which puts the spotlight right back on that strategic diversification we talked about. Okay, finally, let's look at the charts. Purely the technical view. What are the indicators saying about AIE's stock price momentum?
The overall technical summary reading is simply neutral.
Neutral. Okay, no strong trend either way.
Well, it's more confusing than that. When you look at the sub-indicators, the things that feed into that summary, they're all over the place. The analysis is showing simultaneous signals for sell pressure, buy pressure, strong sell pressure, and strong buy pressure.
All at the same time. That sounds like chaos. Like the technical indicators are fighting each other.
That's a good way to put it. It suggests a real lack of clear directional momentum. You know, the various oscillators and moving averages are just generating conflicting signals.
So what does that imply for someone trying to trade this or find an entry point based on technicals?
It basically implies consolidation. The technicals aren't giving a clear signal. The market seems undecided, directionless, based purely on recent price action. It suggests that any significant price move, up or down, is more likely to be driven by fundamental news rather than technical patterns right now.
Which brings us right back to the core story, doesn't it?
Exactly. Back to the fundamentals. The success of the glycerin strategy and the impact of any future government policy changes on the biodiesel side.
So we've got this company, AIE, posted a significant loss recently. But underneath, it seems to have this really solid financial base, very low debt, good liquidity.
Yeah, a strong balance sheet facing major external headwinds. The recurring risk is political and commodity-based. The planned solution is strategic diversification.
Right. So as we wrap up this deep dive, the kind of provocative thought we want to leave you, the listener, with is this. Considering that recent financial shock in 2025, is AIE's long-term plan, using its strong balance sheet to fund this aggressive move into high-value refined glycerin, is that strategy robust enough and potentially scalable enough to truly overcome those fundamental, persistent external risks? The risks of CPO price swings and unpredictable government actions. That trade-off, that bet on diversification, really seems like the central investment decision here. Finally, if you have any other stocks you'd like us to cover, please let us know. Don't forget to like, share, and subscribe to support our team. Thank you.